Did Jerome Powell just release the zombie company apocalypse? The Federal Reserve, led by Jerome Powell, recently decided to hold interest rates steady, keeping them at a 22-year high of 5.25% to 5.5% basis points, or regular points. I'm not quite sure. I don't remember. But not only has the Fed, they've indicated that they also expect to make 3 rate cuts in 2024. This news, of course, sent the stock market into a frenzy, with everybody rejoicing. The pain is finally over, or has it just begun? What could I possibly be talking about? The zombie apocalypse, of course. Well, this time, the zombie apocalypse of companies. How could anyone possibly have anything negative to say about the Fed holding steady and even lowering rates? Well, let's discuss in this video. Starting off with the high interest rate environment. As I'm sure some of you have heard, we've been experiencing a bout of everyone's favorite economic phenomenon, inflation. High inflation has caused way too much money chasing far too few goods, and this has caused a lot of pain for a lot of people. And the only real known way to deal with inflation is to try and pull money out of the economy somehow. And the Fed has 3 tools that it normally uses to do this: open market operations, reserve requirements, and of course, interest rate adjustments. Let's talk about open market operations. This involves buying and selling of government securities, such as bonds, to combat inflation. The Fed sells government securities. Doing this reduces the amount of money available in the banking system because banks purchase these securities, effectively transferring money from the banks to the Fed. With less money available for lending, this increases interest rates and decreases the money supply, of course helping to curb inflation. When the Fed buys back these securities, it increases the money supply and decreases interest rates, which is more commonly used to stimulate economic growth. Now, reserve requirements, another tool that the Fed uses. This controls inflation by manipulating reserves, which are the amount of funds that banks must hold in reserve against deposits. By the way, holding money in reserve is a way that the Fed encourages banks to reduce general public panic that the money that they have in the bank will not all be there in case there is a run on said bank. Just a little FYI. But by increasing the reserve requirements, the Fed effectively reduces the amount of money that banks can lend. Doing this decreases the money supply and theoretically controls inflation. This method is less frequently used compared to interest rate adjustments and open market operations, since it can have immediate and significant impacts on banking operations. Reserve requirements are a more direct tool and can influence the banking system's ability to create money through loans. But then, of course, there are interest rate adjustments. You've probably been hearing about those over and over again over the past couple of quarters as the Fed has been increasing these interest rates. You see, one of the Fed's primary tools for controlling inflation is adjusting the federal funds rate. This is the interest rate at which banks lend to each other overnight. By raising this rate, the Fed makes borrowing more expensive, which in turn discourages spending and investment, particularly by consumers and businesses, basically the only people that lend and borrow money. And this reduces demand and can help to slow down the rate of inflation. Conversely, lowering the Fed funds rate, it makes borrowing cheaper, encouraging spending and investment. But this is generally used to stimulate the economy rather than to combat inflation. And the interest rate adjustments are probably the most powerful tool the Fed has to combat high inflation. You know, the economic phenomenon that we've all been experiencing over the last couple of years. But it comes with a negative, and in some cases, positive consequences. Negative consequences include higher borrowing costs for consumers and businesses. Getting money of any kind becomes more and more expensive. Whether we're talking about mortgages, auto loans, credit cards, getting money just becomes harder. However, it does have some benefits. For example, you may have noticed that yields on savings accounts and certificates of deposits have gone up over the last couple of years. Higher interest rates have that effect on these products because banks receive a higher return on their reserves or their deposits with the Fed and therefore can pay you more. And of course, banks then compete with each other to get more consumers and customers by offering more attractive returns. That said, people generally associate high inflation with high interest rates and the negative consequences that they bring. And one important consequence of high interest rates is exposing individuals and companies who have been irresponsible with their borrowing practices. The current high interest rate environment has been putting a strain on indebted companies, since the higher interest rates mean higher borrowing costs for them, the same way it can for you. The only difference this time around is the explosion of the living dead or zombie companies. Now, what is a zombie? Well, you can think of a zombie company as a company that only makes minimum payments on their credit card. To simplify a complex topic, the concept of zombie companies has a notable parallel in the personal finance space and the personal financial behavior of individuals who only make the minimum payments on their credit cards. Both scenarios involve a cycle of managing debt without making significant progress towards actual financial health or stability. Individuals who only make the minimum payments on their credit card bills find themselves in a perpetual state of debt, just like zombie companies. These individuals are able to keep their accounts active and avoid defaulting, but they're not effectively reducing their debt principal. The minimum payment, in many situations, just covers the interest and a small portion of the principal, leading to a prolonged period of indebtedness. This cycle could technically continue almost indefinitely, at least until that individual makes the decision to stop just paying the minimum due and get on a structured debt repayment program of some kind, or something else changes in their life. For example, they lose their source of income, which forces them into bankruptcy. This situation mirrors the plight of zombie companies, which generate enough revenue to service their debts, typically just paying interest or meeting other financial obligations. But they fail to make enough profit to significantly reduce their overall debt, and this cycle could technically continue on for an indefinite period of time as well, until something changes that forces them to change. In both cases, there's an ongoing struggle to break free from the burden of debt, the debt cycle as I like to call it, with little to no progress to actual financial liberation. Remember when I said that high interest rates have both good and bad consequences? Well, in the case of zombie companies, those interest rates, their increases, they increase the borrowing cost for said companies, meaning that they are no longer able to profit off of their revenue and they're servicing the minimum payments on their debt, meaning that their already squeezed margins are squeezed even tighter, and servicing the minimum payments on their debts becomes all but impossible, thus leading them to bankruptcy. And the consequence of this is that an approximately estimated 20% of companies in the US that are zombie companies, 10% of which are publicly traded, by the way, they could have faced a reckoning much sooner if the interest rates had stayed higher. And I'm sure we all agree that when you handle a problem earlier, the easier it is to overcome. If you let a problem fester and grow, it just becomes harder and harder to deal with until it becomes an unwieldy monster. You know, a zombie. Holding rates steady and lowering them will allow the problem to fester and possibly grow much, much worse as time goes on, creating a bubble the likes of which we have not seen since the Great Depression. Could you imagine if the amount of zombie companies grows from an estimated 20% to 25%, maybe even 30%? What would happen if one day something triggers higher borrowing costs, or some major catastrophe arises where these companies are no longer able to service their debts? That could be up to 30% of the economy. Companies going bankrupt in a few weeks. The fallout could be as massive, if not greater than, the Great Depression. Like I mentioned earlier, it's been estimated that up to 10% of publicly traded companies in the US, they're considered zombie companies. So if you're holding onto an index fund, like the S&P 500, that is tracking the larger US stock market, your portfolio could get decimated. And because of the larger fallout around the general economy, a general stock purchasing panic could ensue, causing stocks in general to fall, doubling, tripling, quadrupling down on the pain. The collapse of zombie companies could lead to a significant increase in unemployment, as these businesses are forced to close their doors or undergo restructuring. This would have an enormous ripple effect on the entire economy, as those who lose their jobs would have less disposable income to spend, leading to a decrease in consumer spending and potentially causing even further job losses. You know, the typical economic cycle of doom. There really is no good way to prepare for a possible zombie company apocalypse in 2024, but there are a couple things that you should think about, starting of course with building up an emergency fund. A collapse of that magnitude will rock the entire country and the entire world, but if you have some savings built up, you'll be able to navigate that better than most. The only other thing to consider would be to actually invest in physical metals. When crap hits the fan, people tend to rush into commodities, and for a good reason. Commodities actually provide value to people in that they can be converted into something useful to someone, in many cases. And a lot of people are high on gold. I don't mind it, but it has its positives and negatives like anything else. I prefer actual useful metals like copper, silver, or other metals, such as the metals that are being utilized in the green economy like cobalt, because they actually have material value to people. They can be added to other processes that could eventually lead to new inventions, things of that nature. But the important thing to remember is not to panic. No matter what happens, the sun will still rise in the morning, and you are still responsible for achieving your dreams. Speaking of which, take a look at the video on your screen right now to learn more about living out those dreams. And don't forget to like the video if you got any value out of it at all. And subscribe, turn on post notifications, while keeping in mind that a goal without a plan is a wish, and a goal with a plan and no action is a wish list. I'll see you in the next video. Peace.